What's up, everyone? It's Ben here, and today we're going to be doing a DCF valuation model for AMD. And if you've been following my previous videos, then you'll see that the agenda looks fairly similar except some tweaks here and there. So first, we're going to be going over a situation overview for the company, then go into trading comps. I'll let you know about the sponsor for today's video, Wall Street Prep, then go into a street-based DCF, then do our WACC calculations and mid-year convention. And normally I don't do sensitivity tables, but today's DCF is going to be a little bit simpler than, let's say, like my previous one for Microsoft, which had a revenue build and EBIT build. We don't have as much data, like segmented data for AMD. So today's just going to be pretty high level. So I wanted to add a little something more, which was sensitivity tables. And then we'll discuss the price a bit. So the reason I wanted to do a DCF for AMD is because the stock has been near an all-time high. So if you look here, you can see that over the past year, the stock has just shot up like crazy. And if you go back even further, I guess there's been some ups and downs, but more specifically over the past year, it's really, really shot up. And my thought when I would look at some of the metrics for AMD here and there, and I always thought it was a little bit overvalued about a year or two ago, but now the company has grown. And so I wonder if it's still overvalued. Like when it was here, the company had less revenue and wasn't as large of a company as it is today. It fell and now it's surpassed its all-time high, right? So I'm pretty curious to know what AMD, like how fairly valued AMD is. And one of its key competitors, NVIDIA, has obviously been shooting through the roof as well. So I thought it'd be a good company to kind of look through. So let's also just discuss a bit about the bull case versus bear case. Now, I'm not a semiconductor expert by any means, but I did do a little bit of research and thought this would provide some good context as to around the company. So in terms of the bull case, strong market position and execution in CPU and GPU markets. So the two of the main competitors for AMD right now are Intel for CPUs and NVIDIA for GPUs. And AMD currently, AMD is like more of a chip designer, so they don't actually manufacture their own chips, but so as the company has grown over time, it's really increased its market share and has a strong market position. So there's good kind of historical track record, and investors generally believe that things will carry forward and the company will continue to do well. Second point for the bull case is one of the most important chip designers at the center of rapidly growing industries like AI, cloud computing, and autonomous driving. I'll go into this a little bit later, but when there were, especially over the past few years, there was a shortage of chips because of supply chain issues. And so it was really like a supplier's market almost, where they could kind of decide their prices. And a lot of these industries right now are growing extremely rapidly. And so AMD is well positioned, not just from an execution perspective, but also just looking at the possible tailwinds that can propel the company forward. Kind of looking more externally, I guess is what I'm saying. The company is in a pretty good spot. And then for the bull case, strong leadership under CEO Lisa Su. Now, obviously, any big public company they'll all have strong executive management teams, but sometimes, especially for like the largest and best companies, the CEO is like extremely important, and Lisa Su is just commonly very revered in the semiconductor space. So huge plus for AMD. In terms of the bear case, weakening PC markets could result in decline of key customer segment. PCs, I think maybe this is mainly because everyone's computers are just getting better, so you don't have to constantly upgrade your PC. And with Apple also constantly, I don't know how much actually, if they're like gaining a ton of share. I think like they're relatively stable, but I think the bigger issue is that people just aren't upgrading their PCs as much. And so that could result kind of in the decline of key customer segment. Intense competition can result in price wars and will require consistently large amounts of R&D, otherwise face technological obsolescence. I think with this space, because, and just tech in general, anytime your competitor just has like a better chip design than you, or just has like better execution and like a new product that results in just faster speeds for any piece of tech, like laptops or smartphones or whatever, then all the companies are going to want the fastest and latest chip, right? And so this will definitely mean that the company will need to consistently be at the top of its game in order to really just outcompete. And that will always kind of result in a lot of R&D spend and potentially a decrease in margins. And the competition in this space is just really intense. Third, susceptible to economic downturn and supply chain issues due to dependence of chip manufacturing to companies like TSMC. So susceptible to economic downturn, I think that's pretty applicable to almost any company, but I did want to focus a bit more on the supply chain issues. Like when COVID hit and there were a lot of supply chain issues, a lot of chip manufacturing companies weren't able to produce their chips and there was like a chip shortage, right? And so that could definitely impact a company like AMD. So that's a bit of context. As I want to next go into some notes and reminders. First, this model will be available for free to download after the stream ends, about a day or two afterwards. So basically what I do is I get this DCF file and then I send it over to Wall Street Prep, and they create like a page for it and stuff. And sometimes that takes like a day or two. So feel free to check in a day or two and you'll be able to download this model for free. This is also a high level DCF based on street-based estimates, not financial advice. People always ask, or sometimes they say in the chat, like, hey, why is this like so high level or whatever? Like, basically what we're going to be trying to do is use what analysts are estimating from the street and then create ranges to see what we need to believe in order to potentially think about investing in this company. Or you might be thinking about this as just like a good modeling exercise for yourself, right? But this is high level because we don't have like a ton of proprietary data or information that we can just take from some sources and just like create our own really like detailed revenue builds or anything like that. Next, if you want some financial statement Excel shortcut DCF tutorials, check them out in the description. You can also go to my live tab on my channel. Just not sure if this is super well known, so I like to go over this. There's like different tabs you can go here, and if you want to look at the like a DCF for any of these other companies, then you go to the live tab and it's pretty easy to just choose the company you want. Last thing, I have an investment banking course. Hopefully we'll release it sometime this summer, so feel free to sign up for that in my description as well. Now with that said, let's go into trading comps. So this is a relatively new thing I've been doing in some of my streams. I've also kind of like categorized some of these companies. So what we do with trading comps as like a basic overview is we look at metrics for the company that we are valuing and then compare it against competitors. And then that way you can kind of see like, is this company trading at an expensive price or a cheap price? How is it growing compared to its competitors, etc. It's what we call a relative valuation versus a DCF is an intrinsic valuation. And I've categorized these a bit into X, which is fabless, not fabulous, fabless. Next, foundries, and then integrated device manufacturers. So fabless is companies like NVIDIA, Broadcom, AMD. These are companies that design chips, and then they work with the partner, like a manufacturing partner, also known as foundries, that actually produce the chips. So foundries are, as you can see here, companies like Taiwan Semiconductor Manufacturing. They have like they have like the most boring company name. Global Foundries and United Microelectronics. And then integrated device manufacturers are companies that do both. So most commonly well known are companies like Samsung and Intel. Also here, Texas Instruments and Micron Technology. So let's kind of go through these competitors. And with trading comps, the actual competitors are never extremely apples to apples, right? So as I just kind of described these three categories, there's like a lot of different types of companies that are in the semiconductor space, and they do different things. They should have different growth rates and margins, but these are the kind of closest we can get, right? And it's imperfect, but no valuation methodology is perfect. So if we look here briefly, market cap wise, we can see AMD is in kind of like the middle of the pack, but we can also see NVIDIA is just humongous in comparison, right? And that's kind of, I think, what a lot of investors are curious about, right? Is AMD potentially like the next NVIDIA? Although it's already like a huge company at around $270 billion in market cap. And then if we also look at the percentage of 52-week high, we can see that AMD is not at, but pretty close to its 52-week high, and same as like all of these other semiconductor related companies. I think the boost of AI has been really like a huge tailwind for all these companies. Plus also the markets are at an all-time high right now. So that's where it currently roughly trades. And then if we look at the revenue growth, oops, I went a little bit too far to the right there. Hopefully this doesn't lag too much when you guys are watching, but on my computer, sometimes it lags a little bit more than the output of what you're watching. So I have to like slow down here and there. Anyway, so last year from 2022 to 2023, the company declined actually in revenue growth by 4%. And this is less than most of its competitors except for NVIDIA, right? And then in 2024, NVIDIA still has some pretty crazy growth. AMD is expected to grow, but it looks like basically, like you can see it's a little yellow, right? Red is not good, green is good, yellow's in the middle. It's kind of in the middle of the pack, and it's really in the middle because it's being just like these two companies, NVIDIA and Micron, are just like way ahead of the pack, right? But if we were to delete those, then NVIDIA would kind of be near the upper quartile. And then EBITDA margins, this was always why I kind of thought that NVIDIA seemed a little bit overpriced, like 1 or maybe 2-ish years ago, because their margins weren't that great. And it seems like there's going to be a huge boost to the company's margins. I don't actually know why AMD's margins are so much lower than NVIDIA's, given that I'm sure there are key differences that actually I'm not too aware of. But hopefully AMD is able to kind of increase its margins over time, similar to some of its like more profitable competitors. And profit margin, free cash flow yield are kind of tell all of like a similar story-ish. And then let's look at trading comps here. So these are some of the most common trading comps that people or investors generally look at. Well, actually, EV over revenue is more common than EV over EBIT. But we can just see here to see how expensive is a company trading. And what these metrics basically tell you is how much for every dollar of EBIT or EBITDA or earnings per share, how much are you paying? So for NVIDIA, for $1 in EBIT earned, we're paying $27. For TSM, for every $1 of EBIT earned, $14. So the higher you're paying, investors are paying right now, that means it's more expensive. It has a lot more potential to face a steeper decline if the company doesn't execute and kind of provide like spectacular earnings that just justified these high multiples. So multiples can be high, and it's okay as long as the company, quote unquote, grows into its multiples. And what that means is just, multiples could be high today, but if the company grows at, like, let's say 100%, then that means it's going to double its, let's say, its EBITDA. Then this multiple would essentially by 2025 become 16.5x. That's, like, roughly speaking. There's a lot of things that would change. Like if it was truly growing at 100x or 100%, then these multiples might be even higher. But essentially, that's kind of what I mean. And anyway, the key takeaway here is that AMD is still trading at a very high multiple, 33 times its 2024. So kind of like next 12 months. It's expensive, basically, is the point. More expensive than all its peers, despite not necessarily having the highest margins or having the highest growth, right? So looking at this, I kind of think at the end of the whole DCF, we might get to the conclusion that AMD is a bit too expensive. Last thing about trading comps here is premium or discount to historical multiples. So what this is just looking at is the company trading more expensively versus the past for its previous multiples, or is it at a discount? So we can see here right now compared to the past 1 year, Nvidia is trading a little on average 36% higher than it was in the past. So it's like 36% higher multiple than in the past. Over 2 years, 66%. Over 5 years, 19%. Essentially, what this is saying is that AMD is not trading super cheap on a historical multiple perspective. So all signs that kind of say, if you're a true believer in AMD and you think the company is going to just skyrocket for whatever reason and these numbers don't capture that, then sure, invest in the company. But if you're more conservative and you want like a more of a margin of safety, let's say, then AMD is probably not the best for like a safe, quote unquote, investment. So those are trading comps. Next, let's talk about Wall Street Prep, the sponsor for today's video. So they have this buy-side financial modeling investing course, which I think is extremely informative and just like a well-made course. And I plan to actually go through it myself this summer after I graduate from my MBA, because right now I have so much class already. But you can see here it's led by hedge fund veteran Brett Coffran, I found him on LinkedIn, and he has a ton of really great experiences. So let's let this load. But he's worked at companies like Citadel, D.E. Shaw, Schoenfeld. You can see here all these, like Greenhill was back in 2007 to 2008, a much higher profile elite boutique investment bank. Nowadays, it's kind of fallen off, to be honest. But anyway, a pretty, well-experienced hedge fund investor who goes through a lot of the kind of topics that people seem to ask about in a lot of these streams. So, for example, detailed revenue builds, thinking about business momentum, forecasting, just generally understanding, is this a good business or not? And you can go through the table of contents to just see a ton of just really helpful videos. Buy-side model construction, I think a lot of people would be interested in. You can go through, each of the financial statements. So a lot more detailed than what we're going through today. So if you want to check them out, be sure to use my code this course out, then be sure to use my code RareLiquid. You'll get 20% off. Or if you're interested in any other course that Wall Street Prep provides, then you can use that code to get a discount for any other course as well. So feel free to check them out. I'll leave a link in the description. And with that said, it's time now for the DCF. And as I kind of set this up, I'll check the chat periodically. So let me see if there's also something I realized, like I used to So I would go through my previous streams and I would not be able to see the chat because it would be like, this chat is not available. And I realized after Googling it that whenever I start my streams at the beginning, there's like this lag where I start the stream, but then this YouTube Studio or wherever I'm hosting the stream doesn't show me until like 10 seconds later. So I always wait 10 seconds. And then after the stream is published, then I edit out that first 10 seconds. And then when I do that, apparently it just deletes the chat. So this time I started talking right away and the chat should be there for replay. Anyway, if you guys have any questions or anything, then feel free to add them in the chat and I'll get to them periodically. I see one question. Have you got any advice for people wanting to create their own DCF models without databases like FactSet? What are some good assumptions we can make for revenue and EBIT projections? Yeah, I'd say this is pretty tough. I would say that there are some companies. I used to kind of use one called like Wallmine, I think. And I would just Google, financial projections for financial projection databases or something like that, sources. I personally don't know off the top of my head, but I think there would also probably be a heavy reliance on historicals, which you could find on like Yahoo Finance, Google Finance, BAMSEC.com. Can you give me an example to calculate working capital? We'll go through that. Or I can go through that a little bit later today when we go through the cash flow statement and project working capital. Would you be able to show how your dashboard and workflows are set up? For FactSet, I don't actually set up anything. It's just automatically set up like this. It's just the workstation. I don't really make anything custom. I just enter in the company and then go through this menu bar over here. So, okay, so let's go into the DCF now and just gonna set up some of the more basic stuff. And every time I do these DCFs, I kind of like get a little bit nervous that I might forget a lot of the shortcuts and stuff. But so far, I do these streams like around once a month or so, and it kind of feels like riding a bike. So I guess that's a good thing. Okay. Okay, this seems to be lagging a little bit. Okay. So what I'm going to do is just some formatting stuff. By the way, I'm curious to know in the chat if for any of you guys, this is like your first stream you're watching. Like my guess is that a lot of people who watch this maybe watch this, or I don't know. I'm curious, like, are you guys more regular viewers or who have seen these streams before? Or has YouTube just fed you this video and you have never seen anything like this? Oh, cool. A lot of first timers. Okay. So we'll have assumptions here. Before the stream, I did pull together some of the key information we need. Okay. From my end, I mentioned this before, but my computer lags a little bit. Hopefully it doesn't when you guys watch it, but I think I need a new PC because this one is, I think it's because I have a laptop and I have like 3 monitors it's hooked up to, and so it's just not powerful enough. Okay. But anyway, income statement. So we're gonna need the income statement, and then later on we'll need cash flow items, and then we're gonna do the DCF. let's kind of populate a lot of this stuff. Also, I know a lot of you guys have been asking for like other types of modeling, and I am actually close to preparing like an LBO from scratch type video, and little TBD on when that'll be, but I'm hoping that it'll be in, let's see, probably in like a month. So be on the lookout for that. Okay, so another great thing about doing the DCF for AMD today is that the company released Q4 earnings, and so the entire 2023 is all released. So we have all that information, which is great. Versus like when I did the Microsoft DCF, we would have like not the full year's worth of information. Okay, but anyway, so let's, I think we'll probably just do a 5-year DCF. But we'll see what the numbers look like. I see a question on why do you put an X on each line? So especially when models get super, super long and like, let's say hundreds of lines, then you're going to want to go through to each section quickly. And these X's just help you do that. So when I press Control and then the down arrow, I can go to each of the different sections quickly. Oops. Okay, so let's start inputting the model, or inputting this, model, some of the key line items we're going to need. So these include revenue, 10% growth, we're going to need our EBIT, percent of sales. Then we're going to need taxes, then tax rate, So let's also, what I'm going to do is make these actuals versus expected. What's going on here? Weird. Huh. Usually this works. Oh, my computer's so laggy. Okay. Okay, that worked. Okay, also curious to know where you guys are joining from. So let me know in the chats what countries you guys are from. But okay, 2016, so sales. we can pull from FactSet here. And luckily, everything is already calendarized to December. So we don't have to do anything, any calendarization. Percent growth, pretty easy to calculate. Get our current year divided by our previous year. Oh, I see. Wow, Uzbekistan, Italy, South Africa, Spain, Sweden, Germany, India, Germany, Bolivia. Wow. Basically no one from the US. That makes sense still, because right now people are either in classes or usually school. Okay, and then let's go to EBIT. Operating income. All right, let's see if all of this, if there's anything funky. Non-operating income net. Non-operating interest income. Okay. So, but one thing as I'm looking at this, the company's EBIT looks pretty low, and the company's market cap is like 270 billion. So I feel as though this may result in a pretty low valuation. But we'll see what happens. Percent of sales. I just have this, basically what I did is change the formatting to add parentheses when it's negative. I, for whatever reason, just prefer that. What's going on here? Divided by. Oops. Okay. Yeah, this is very interesting. So the company's revenue growth and its EBIT margins are all over the place. It's going to make it pretty hard to actually model. And we'll probably have to rely a bit kind of strongly on the analysts here. We'll see what happens, but this definitely does not seem like an easy, oops, didn't turn off my Slack. Definitely does not look like it's going to be easy to model this company. Sorry for the Slack messages. Okay, so let's get to our, okay, we have income taxes here. How does this compare to our previous, or to these? Let's see. Tax expense in 2016 is 11. Income tax 11. Okay, these numbers are a bit different. Okay, I'm gonna have to go dig into the actual financial numbers, but let's go to bamsec.com. Let's see what as I wait for all of this to load. Hi, what do you recommend for getting the most knowledge in VC fund growth strategies, such as structuring the deal flow, time savers of productivity tips, and financial modeling for startups? Well, I mean, there's so much packed into this question. But one thing I'll say about the modeling for startups is that it's not as much about doing DCFs, but more about understanding the total market and then seeing how much of that market this company can acquire share of. So that's where a lot of VC, they call it TAM, total addressable market. That's where a lot of VCs like focus on, plus like also like qualitative stuff like the team. But I don't know directly like what resources there are for kind of like practicing that. In terms of when I do streams, I actually don't have like a set schedule, but maybe I should definitely try to do that. Right now with school, things are so up and down. Things change all the time, so I'm not as like regimented. Anyway, let's go into fiscal year. Let's go into some financial statements. Okay. Basically, I'm looking for tax info. I just want to double check that our numbers are correct. So let's see. 24 quarter 4 annual financial results. So let's check revenue numbers first. 2023 should be 2020 or 22.7 billion or so. 2022 22.7 billion. Okay, and then 23,601, so that's correct. Then let's think about our EBIT. Operating income 401,1264. So 401,1264. Different, not good. Let's see what's happening. Or let's check if it's similar here. Is that when I go through, like right now, is the video lagging at all for you guys? Because it's super slow for me, but hopefully it's not for all of you. But I'm gonna check 2023 operating income 4674. 2023 here is 401. Oh, wait. Non-GAAP. What does non-GAAP include? So there's definitely some huge, okay, good to know that it's not lagging. There's definitely, so GAAP just means what after generally accepted accounting principles. These are like exactly to the T, if you had to follow what guidelines there are, what the numbers are, and you just report it. Non-GAAP is like a bit of a free-for-all. So companies are able to add back things to things like your operating income in order to provide like what they think is a more fair metric. And so the tricky thing is kind of, there might be some one-off things that they are adding to their EBIT that does make sense to include, but let's try to see like what those numbers actually are. So, okay, I think it's here. Okay, so the gap income are these figures here for the year. And then it seems like they added back stock-based compensation and amortization of acquisition-related intangibles. So they probably added this one back because it's a one-off like item. So a lot of times when companies, like in this case, have made a huge acquisition, they're not going to face this deduction every year. So in order to account for that, kind of like they are just kind of this is my assumption that they're just adding it back for this line item, acquisition related and other costs. They're basically saying like in normal years we will not have these costs. But stock-based comp, I would say generally speaking, people argue that you should include as a real expense. So I would love to see non-GAAP figures that do not have stock-based comp included. Anyway, so I think the tricky thing is just figuring out what numbers we want to use, and thinking through that right now. So let's see, this 2023 number is 4674. That's like what analysts believe, or I did believe. Let's see if there's anything else helpful here. I personally think that the numbers that we're seeing here are just way too low. So let's see, 3711614. Okay, these don't even tie here. Unusual expenses. This is tricky. Gonna go to FactSet to dig into this a little bit. EBIT. See what's included in here. Okay, operating income before unusual. Okay, so it looks like they're starting, or what is this? Subtracting operating expenses from revenue. Then they are adding depreciation, amortization, subtracting amortization, plus D&A, or minus D&A again. So that nets out with the above, plus amortization minus R&D. Looks pretty messy. Maybe there is, let's see, income statement. And I know this is taking some time, but I didn't expect this, first of all. And then it's also a really important number that's going to drive our valuation. So I want to make sure we're using the right number. EBITDA is super high in comparison. Oh, DNA is high. Net operating income. Okay. Well, what I personally am thinking right now of doing is and it's going to be kind of painful, but my thought is to calculate my own operating income for the historicals, rather maybe for 5 years, not like 10 years, where I'm just I'm not taking out, or I'm not adding back stock-based compensation. Okay, so let's get started with this process. Amortization of acquisition-related intangibles. Let's see what this would do. Okay, so my thought is, let me know in the chats if you guys, have any other suggestions. But this non-GAAP operating income adds back stock-based compensation, amortization of acquisition-related intangibles, and acquisition-related and other costs. And my thought is to basically get this 4854 and subtract out stock-based comp. I think that does get us to a non-GAAP operating income, but it incorporates stock-based comp as a real expense, which generally you do when you're doing a DCF. So let's just calculate that. So 4854 minus 1380. And then here also equals 6345 minus 1012. And then, so I don't really trust these numbers essentially. And then we're going to have to go through and find the other years as well. That's why this is kind of annoying. I'm going to guess it's this one, but let's look at... So usually if you're working in banking, then you're going to have BAM SEC. I don't have it right now, so then I'm going to have to try to kind of guess and find. Actually, I could just go into the actual filings. Okay, so 2022, I need 2021 and before, but I'm not sure if the non-GAAP calculations will be in here is a problem. Actually, it probably won't be here because it's a filing. Okay, this was released on February 3rd, 2022, so it must be one of these. Okay, it's this one. So hopefully it has another calculation. Yes. So we have year ended 2021 and 2022, non-GAAP operating income here. Okay, sorry guys, computer lagging a little bit on my end. While it's, oh no, Excel says not responding. Okay, there we go. Let me see if you guys have any questions. So I've seen a lot of your videos building DCF model, but I personally prefer to build 3-statement models just to perform detailed analysis. Is it okay in banking considering it's time consuming? In banking, you only do as much as you need to do because you have so much to do. So if you don't have to build a 3-statement model, then you won't build one. Okay, so anyway, for 2021, it's 4069 minus 379. So that's here. You can see 4069 minus 379. And then the year before that is 1657 minus 274. Okay, so these numbers are looking a little better for a company valued at 270 billion. Like beforehand, the EBITs were just like so low. It was going to give us like a extremely low and definitely would undervalue the company. I would still say that EBIT is actually still pretty low for a company valued at 270. But okay, so now I think we have 4 years. Let's go all the way back to 6 years. Which would probably be, so let's see, we need 2019, and it'll be around this time. So again, we can see GAAP operating income here. Year ended 2018. Oh, dang it. I went back too far. We need 2020 here. Okay, why aren't you working, computer? All right, here we go. So what I also do like is that the company's been very consistent. It's constantly providing like the same kind of different line items as we're getting for our non-GAAP. Anyway, here it's 840 minus 197. And then 2018, 633 minus 45. No, 137. Okay, that took longer than expected, but okay. And since we just only have numbers from 2018 onwards and 2016 is so long ago, what I want to do is just actually delete these 2 years. So we'll look at from 2018 onwards. And yeah, the other thing we wanted was taxes actually. I just wanted to double check on taxes as well. I also think this is actually, when we look at estimates for our street estimates, I feel like we might run into an issue for EBIT, but we'll see. Taxes, where are you? Seems, oh, here it is. Wait. Oh, interesting. They do provide a breakdown for their different segments: data centers, client, gaming, embedded, all other. So if you had a lot of data, actually, you could just forecast this for each segment for the company and build like a detailed revenue build. I don't see taxes. Okay, everything is moving at a super slow pace because this isn't loading. Okay. Let's find our taxes. Oh wait, this is just a presentation. A lot of times, or yeah, very often when companies release their earnings, they also provide a presentation. And I used to go through these a lot, actually. But they don't always, oh, this is helpful, actually. Effective tax rate, 13% of pre-tax income. That is pretty much the number we need. We don't have a number, though. Okay, but good. I think I got what I needed. One more, sorry, I've been asking this a lot throughout the stream, but one more lag check in the chat. Can you let me know if there are any, is there any lag when you guys are watching this? Okay, so tax rate here was roughly 13%, just for you to know. And let's see what the taxes actually look like here. So in 2023, tax rate, tax rate here is tax expense divided by pre-tax income. Oh, perfect. Okay, so it looks like basically I was trying to see if this number is, if these figures, given that we had to calculate our own EBITs, if this tax figure could also be reliable. And I know we only checked one number, but taxes are usually pretty like not as important as revenue and EBIT. So looks like we can rely on these numbers essentially, which is good. Okay, I actually also want to check what the estimates look like here. So operating income 2023 here is 4674 versus what we have 3474. 6345 4069 6345 4069. Okay, so basically what is happening is that these numbers are from analysts, and they have been adding back to operating income as well. They have higher numbers, or however FactSet is calculating it, they have higher numbers than, oh, it's probably because they're not subtracting stock-based comp. But okay, the reason I'm kind of debating about what to do, because here we're going to need to start using our estimates, right? So okay, so I do see there's some people say it's no lag, some people say it's a little bit. Okay, hopefully it's not too much. Okay, so there's that. And then operating income 2024. Taxes. Also kind of just look at here. Okay, interesting, 13% all the way. Okay, so where does this leave us? Okay. So just quick comments based on what I see here. Revenue growth, very up and down for AMD, but analysts generally seem to think that over the next 5 years, the company is in like a really good spot, double-digit growth. EBIT, what I'm thinking actually to do is to just use the analyst, or use what FactSet had here. So basically copy paste this across, because you know, we did go through some calculations. Basically what I was trying to see is if we use just GAAP operating income, then I think that would be a mistake because it's far too low and there are some items that we should be adding back. And when you're actually building models like a DCF, then you generally do want to have as close to what you think is representative of true cash flow. And so you do tend to like add back items that you think should be added back. And that's what it seems like FactSet is doing here as well. So I'm just going to trust FactSet's numbers over the ones that we calculated. There's probably some additional items that they're adding back for whatever reason. And I think these metrics like roughly make sense to me. It's like not crazy to me that AMD would get to like the high 20% in EBIT margin. Like that's not outrageous. Now we're not gonna, and then for taxes, this looks super reliable. Seems like we can just apply like a 13% tax rate, and it's always great to see like something that's like very consistent because it's a lot more reliable. Okay, so cash flow items here we have D&A, and then percentage of sales, CapEx, percentage of sales, and then change in net working capital. And here we'll have percentage of sales and percent of change in sales, and see which one seems more reliable. D&A you can find in our cash flow statement from 2018. CapEx, also in our cash flow statement. here. And I like to personally, this is like personal preference thing, but I like to keep everything positive and then subtract out what's needed, instead of like when I added a negative sign here basically because I like to keep everything positive, and then we're connecting to a negative number right now. Then change in net working capital. This one, also cash flow statement. Here, 2018. So we have negative, that's interesting. Negative changes in net working capital. Receivables have declined. Interesting. Okay. So usually, so this one we, let's see. I'm trying to think about what sign to use for this one actually. So it's negative, change in working capital. So normally we subtract out working capital and it's positive. In this case, working capital is negative. So for this one, I'm just going to leave the sign because this is like, for instance, if EBIT was negative, then we wouldn't make it a positive number, right? So I'm going to leave change in net working capital as a negative number. Let's see if I can fix this. Oops. All right, so percentage of sales. And I'm going to press F4 twice so that we can just copy this down. You can see this is divided by revenue consistently. And then this figure is our change in sales divided by, our change in net working capital divided by our change in sales. So it basically looks like these numbers are too all over the place. We'll probably go with change in sales. And DNA, look, I think what happened in 2022 is there was just probably like a really big acquisition that caused like a spike in amortization. But for for these numbers, it seems like we can just use historicals around 2 to 3%. Also very interesting that DNA is higher than CapEx because normally not, but okay. So I want to answer some questions before we go into the DCF. Why are you using the analyst EBIT if we just went and modified it by removing the stock-based comp? So this is for the reason I'm doing that, and I should probably clarify before I do the DCF, is because these numbers that we're going to be relying on, the estimates that we have, the analyst estimates, like I don't want to, it's ideal to be looking at things consistently. And in these figures here, if we use just our numbers and then compare them to like the estimates, then they're not really like apples to apples. And before, when we were looking at the GAAP EBIT, the numbers were just like way too low. And once we calculated our own, it got closer to the numbers we have here. Now, in an ideal world, like we do like have more understanding of what goes into like the EBIT numbers here, and then like we take out like stock-based comp and all of that. What I'm kind of just like trusting right now is that the analysts who like estimated these numbers and use them to value AMD are taking out what they should and adding back what they should, essentially. And since the numbers we calculated are relatively somewhat-ish close to these figures, I think it's just like simpler for this exercise for us to just trust these analyst numbers in a sense and go with them, instead of doing like an apples to oranges type of comparison as we create our estimates. So you can argue that that's like the problem of not really like creating your own pure non-GAAP EBIT, I guess. Like we don't exactly know what goes into these numbers, and that's why this is like a high level street-based DCF and not like, that's why I say like be careful of using this for like investing. Like this is a good way to kind of get a good range, but you need a lot more granularity if you're actually going to invest. Okay. As I do some of this stuff, let's see if there's other questions. I see a lot of questions about color coding. So green means you're linking to another sheet. And then I'm going to add one that's purple here. Purple means you're linking to the same sheet. I think different banks do this a little differently, but at JP Morgan, we always did it this way for whatever reason. Okay, so we have revenue, and we don't need to calculate growth twice, but I just did. And then we have our historical taxes. Okay, so this is now, we're now kind of at the, oh, oops, this is not correct. Let's just connect to our tax rate. This next part is probably the most, the most important part of the entire model, which is projecting out our revenue and then our EBIT. And then after that, we're pretty much like everything else is pretty easy. So let's see how kind of like tricky this gets. So we're going to have a conservative case, base case, and an optimistic case. Okay, so, and then what I want to do is take the formatting thing here. Paste it here. Move this to the right. Okay. So let's see what we're going to do here. For revenue growth, so if we were, these are what we have from our analysts' estimates, right? Something to note is that 2024, so we have 12 months left, or 11 months left of 2024. And the first 1 year that analysts project to is usually like a pretty reliable number. And then also up to 2025, like maybe like basically that's 2 years out. Starting from 3 years out, it becomes less reliable. And let me show you guys why. If we go to FactSet, okay, so if we go to FactSet, AMD is here. If we go to estimates, okay, estimates, and then broker outlook. You can see here. Okay, so let's take a look at sales. Sales, okay. And let's take a look at 2024 expected. Then you can see that there are a ton of analysts that are projecting 2025. Also a lot. Let's see, 2026. It drops like a crazy amount, right? So 2026 onwards, basically, it's not like a really good comparison. 2027, probably even less. Basically, what our sales estimates are here from analysts is just an average of all of these estimates. So with that said, I'm going to actually exit out of FactSet. So hopefully my computer is faster. Okay. So these numbers, not reliable. Just going to mark it that. Okay. And you can kind of, for me, it makes sense to now, like, why these numbers are increasing. Like normally when you have a company that's growing, sure, you can have times where the revenue growth increases from 1 year to the other, but usually as your revenue increases, your growth rate should decline, right? Because it's technically harder to grow from when you're at a larger revenue figure. So then, what reason is there really that AMD randomly in 2026 is going to grow at a higher rate than in 2024 and 2025? Like really, there's no reasoning for that. It's not like these analysts have some kind of special magic 8 ball where they're able to say like, oh yeah, in 2026 this is going to happen, and I know AMD is going to grow faster, right? It's instead the issue was really that there are less analysts projecting, and so there was just like a inflated figure here. Instead, what it seems like is that somewhere around 19-18% is makes more sense for the company's growth rate. And I think for our base case, like we can kind of pretty much just take that at face value. And this is like our base case is our street-based estimate essentially. And then it's a matter of like where can this growth, what can it go down to, kind of. Let's take a look at our comps. So like if we look at NVIDIA, maybe not the best comparison. Got other fabless companies. So Broadcom, 39%. Basically what is like a good comparison is if you look at a much more established company and see how much they're growing to see what your growth rate might be 5-10 years down the line. What's challenging about this situation is just clearly because semiconductors, for whatever reason, had like a big down year last year, and then they're expected to grow this year. Makes it challenging to really figure out what kind of growth rates to apply 5 years down the line. But generally speaking, like what I think is that there will be like a slow decline in growth rate. Like I don't think that it's going to go from like 18% to something like 3% in the next 5 years, because there's just going to be so much, like unless something bad happens to AMD. So this is tricky. 19% and 18%. 2028. I mean, if you look at these historical growth rates, also things jump around quite a bit, right? 2019 to 2020, I think AMD I think they had some kind of breakthrough, and that's why they were able to jump their revenue so much over these years. Plus, I know there was like a lot of like crypto mania at this time that caused like a huge increase for chips. And then 2023, big decline. And then things are kind of normalizing back to around 19%. So I don't want to let's see, what do we put here? 2028. Because I'm looking at the historicals and kind of just like roughly what makes sense to me is something around like 13% or so. Like I think we're not being overly aggressive or conservative if we have something around there. But let me just set up the assumptions tabs first. Okay, and I'm gonna steal from the Microsoft DCF I made, but this is gonna be too much actually. You guys see, while this is, for whatever reason, this is lagging, I'll answer some questions. I'll answer kind of the career-related questions a bit. So if I am applying for a finance internship at a bank, is it required to know how to do this with high confidence? No, I actually didn't know how to model at all or build PowerPoints that well. You learn really on the job, but with that said, like if I could have, before I started, I definitely would have practiced and learned how to model, because it just gives you a big leg up when like they're trying to think about like, oh, what analyst should work on this, and if you've already modeled before and you like are good at it, then you can get onto like the better projects. Like the first projects that I got when I was in banking were not great. I think I would have benefited a lot if I knew how to do like models and stuff, or build models. Okay, so we're definitely not going to have this much granularity. So let's see what to do here. think we're just going to have one revenue switch, one EBIT switch. So let's just have So let's call this operating assumptions. I have revenue, EBIT, EBIT, taxes, and cash flow assumptions. So then we'll have here D&A, CapEx, change in networking. Actually, I don't think we're gonna have switches for these. Actually, we're gonna have oh, we're not gonna have them for taxes either. So let's delete this. Cash flow, I don't think we're gonna need switches for these either. So let's just have it be like other assumptions. We will need one for WACC, terminal growth rate. Okay. It's getting a little messy. Let's just delete all this. Okay. Okay, so maybe we'll need some more switches or something soon, but for now, I think roughly speaking, we can have what we have here. Let's just call it operating. All right, so the first thing that we're going to need is a thought on 2028, what revenue will be. So what we want here is revenue in 2028. Okay, so let's see. So we're 2024, 2025 growing around 19, 18%. So there are a few things that I've been thinking about. One is, we could grow it or decline it at a certain rate. So, like have it grow down X% each year. like 10% each year or something. But then I think what I think makes sense is there's like a lot of potential that AMD continues to grow at high digit percentages over the next 5 years. Like if you look at NVIDIA, right? That company's huge and it grew 105% and 60%. There are some companies here growing, 21%, 39%, and they're also large companies, right? So AMD does have potential to grow at that kind of rate as well. In the past, historically also grew 44%, 68%. So it could really surprise us and grow super fast. So what I want to do here is just grow it down, just grow it down slowly. And so let's see what the difference is between these years. It's like 0.5%. I think basically if we grow it down, something like 15%, I think in 5 years, that makes sense to me. Basically about like 1% each decline each year. Probably gonna need this down here actually. So for our base case, we're gonna grow it down to 15%. Oops. All right, my computer's lagging so much. Okay. Now, I know we kind of like just took that number out of thin air-ish, but what the reasoning behind, first of all, like if I had more access to just like industry report of where semiconductors will be in the next 5 years, like maybe we kind of look at that. But generally what I'm implying here is that the company's not going to slow down that much. And there may be spikes of where the company just like really grows beyond analyst expectations. But there may also be years when things go awry and you see this like flat or even like slightly negative growth, right? And I think also when we look at some competitors, we can see that there is potential to grow higher, right? And by keeping things relatively stable, I think what this basically captures are both the highs and the lows. So that's why I think like it makes sense for our conservative or for our base case to basically linearly grow down just a little bit, and that it kind of accounts for all factors or all kind of like up and potential up and downs. So let's just grow this down to let's get our previous year minus 15% divided by our years. Okay, so basically just going down very linearly over 5 years. Actually, let's make this purple. Okay, so now when it comes to 2024, 2025, or all these years, 2024 and 2025, these are years that we can somewhat reliably believe in because analysts are better at predicting the near-term future because they talk to management all the time. So 2024, I guess since we have 11 months left, like typically what we might do in the past is take like a really small haircut. But for 2020, given that we have 11 months there, we could be a little bit more conservative and a little bit more optimistic in our current situation. So let's go over here. So for our conservative case for a revenue for year 2024, yeah. Well, anyway, what I want to do here is kind of start with a negative 10% and increase 10%. Like plus or minus 10%, I think that's pretty fair. Times 1 minus 1 plus. And then here, times 1 plus this. I think that's a pretty good range. I can't imagine that AMD would go below or above this range too much, given that analysts are pretty good at, figuring out, or they have a pretty good handle over the next few years, or 1 to 2 years. Okay, so let's make this purple too. Also this. These are calculations, so they're black. Okay, and then 2025 to, let's see here. So right now I'm debating whether or not we should just choose, like if we should use the street estimate for 2025, or we kind of just choose a 2028 number and then decline it there. I guess in order to have consistency, it would be good to why don't we base things off of this 15%? So 2028, what I'm going to do for these numbers are so let's start with a negative 20% here and then a positive 20% here. And my thought here is we choose, so in order to make everything consistent, percent and then equals this times 1 plus that 18%. I think that's pretty fair. I mean, there is a chance that this conservative case is not conservative enough because who knows what can happen in 5 years, but in that scenario, I don't know. AMD would just tank anyway. So let's see what these numbers shape out to be. We're going to linearly just decrease things for now. That did not work. Oh. Okay. Then copy that here. cheat a little bit, use my mouse. Okay, so base case growing from 19% down to 15 over 5 years, conservative 17 going down to 12%, and then optimistic 21 to 18%. I feel like I'm okay with these. I do think there's always a chance, you know, that I mean, AMD's, you know, $23 billion-ish company. I think there's still a lot of room to grow. So somewhat, these could somewhat be, yeah, I don't know. It could go either way, but I think these like aren't like overly too much, like too conservative or too optimistic in my view. So, okay, I'm good with these. Let's add our switch. So equals offset. Go to our current cell, then go to the row, or switch here, and then 0. We're gonna anchor this. Oops. Times 1 plus our growth rate. Okay, halfway there of the hardest part. Now we need to do our EBIT. These are wrong. All right, so similar to our sales, our EBIT, not trustworthy from 2026 onwards. Directionally, things are just moving up, which is a great sign for the company. And, you know, previously the range seemed to, over the past 5 years, be around 17-ish% to 27% at the peak. Now it's around 26 to 30%. I think basically I don't want to go too much higher than, like, the absolute max we'd go is probably 35% over the next 5 years. Let's see where some competitors are at. Now these are EBITDA margins, so not exactly the same, but you can see AMD 31%. I think there is something definitely different with like NVIDIA's business model that allows it to be so high margin compared to AMD. Like there must be something that I don't particularly know. And EBITDA margins are different from EBIT margins, but I think this is still a good kind of thing to look at to see like, oh, exactly like how much can our EBITDA margins go up? Or EBIT margins go up? So yeah, the range is quite broad. Okay. So things are a bit on the up and up. I think on a, like the most optimistic scenario is, seems to me that the EBIT margin's at somewhere around 35%. And then so working backwards to our more like base case, we want something definitely less than that. I think somewhere around like 32.5% makes sense. And then I think in a bad case, like in a conservative case scenario, if it kind of maintains like something around 30%-ish, something around there makes sense for me for now. Okay, so let's do EBIT. 2020, oops, let's do it here first. EBIT for 2028. Okay, so for our base case, I'm gonna make it 32%. Optimistic case, not 35. Let's have it be 34%. And then our conservative case is pretty much, it stays flat, right? Like it's not going to grow. But 30% EBIT margins is actually pretty good. So like if you're growing at double-digit revenue growth and you have EBIT margins of like 30%, that's, you have a pretty good company. Okay, so 32% there, 4% here. Okay, and then let's grow this. No, this one is plus the difference of, then we want the same column. Oops. Okay, that looks good to me. Optimistic case. Sorry, was checking something. Okay, so conservative case, if we were to decline by 10%, that's around 20. So margins don't go up or aren't as volatile usually as revenue growth. So I'm gonna just take a decline of 5% here. And then for optimistic case, 5% as well. Oops. All right. And then I guess we can just grow these. So let's see. Change this. Oh, 53. Okay, what's going on here? K53 plus O53 minus L53. Oh. Okay, this J basically should just be K. Okay, cool. So conservative case 25 to 30%, base case 26 to 32%, and optimistic 27 to 34%. I think that works for me. So let's make our switch now. Oops. Oh, equals offset that comma. Go to our switch. 0. Okay, hardest part done. Oops. All right. As I'm trying, the next parts are going to be pretty quick. So let me know if you guys, I'll try to answer some questions as I work on the next few parts. So let me know if you guys have any questions in the chat. But okay, so that's done. Taxes, we can see that it's just around 13%. Even also our analyst estimates was around 13%. So I'm just gonna take an average of the past 2 years. Like these seem like make sense. And of course things can change. I think for now, totally fine to use. Okay, so this is EBIT times tax rate. It's 230. I have class. Oh man. Okay, I'm gonna have to wrap this stream up in the next 30 minutes, hopefully. So earnings before interest and after taxes, that is our EBIT minus our taxes. Then we have D&A, percentage of sales. Let's just copy paste this over here. Actually, we can just copy paste all of this. D&A, copy over from here. I see a question. Have you bought any stocks recently? What are you most bullish on? Obviously not investment advice. I haven't been buying stocks actually. I have mainly just been buying, or not, haven't been buying individual stocks, just like ETFs essentially. And I actually don't have like a ton of disposable income right now because of like student loans. So I think once I pay those off, I will have more interesting like fun stock picks that, you know, I just do for fun. Alrighty, we're almost there. So what I'm thinking about for D&A and CapEx is just using like a 5-year average-ish, but there's like this one weird year for D&A, right? So I'll discuss what we're going to do there. Basically, I think what makes sense is to take an average of kind of like the past 5 years, but excluding that one weird year because that's going to mess up all our numbers, right? But for CapEx, we can just take from all the years. So, and then we can just keep it stable. Overall, like this isn't going to impact our valuation much at all. So no need to like lose too much stress or worry too much about this, because these two generally offset each other, right? Like you add DNA and subtract CapEx. They're also very interlinked line items. So your cash flow shouldn't change too much as long as these assumptions are like reasonable. Okay, next for change in net working capital, also a little tricky here given the numbers change a lot, but I'm just going to take an average. Seems like negative 9% probably makes sense. Okay, so change in net working capital, percentage of sales, same thing. Awesome. So we are now very close to calculating our free cash flow. Okay, so unlevered free cash flow, that is our EBIT plus DNA minus CapEx minus change in net working capital. And we will need our present value of unlevered free cash flow. And then we're going to need to calculate our discount period. And then once we do that, we will get our terminal value, present value of terminal value. And then we can calculate our enterprise value. Then we add cash, subtract debt, that gets us to our equity value. Okay, but to get present value and all that, we're going to need our WACC. And so let's calculate that. I'm going to steal from our Microsoft DCF. Format. All right. So let's see, delete this stuff, delete this, delete that. Okay, market cap of AMD. And the company is still trading right now, so this is going to change. Dang it, I went out of FactSet. I need to get FactSet. Okay. Let's see some other questions. Hey, can you make a pro forma balance sheet tutorial? Yes, I will. I want to make an accretion dilution type tutorial in the future. So, when I'm doing that, I will be looking at like the different financial statements. Another question: if I'm applying for a finance internship at a bank, oh, I already answered this one. Okay, I get we need to be conservative with the base case, but if we state that base equals street base, then why not use the analyst revenue growth projections and then modify the conservative and optimistic cases? The reason for that is because I don't trust the revenue growth projections in the later years for in the last few years. And I kind of went through that earlier in the stream. So that's why I prefer to use my own. A lot of times, like those estimates can just be like overly inflated or deflated. So I think it makes more sense to use what you think makes sense for the analyst estimates you can trust, and then also looking at like historicals. So let's see. Current market cap, 278 billion. And then the other thing we're going to need is beta, which is on the down here in the middle here, you can see 1.61. Okay, it's 278 billion. And then beta was 1.61. Risk-free rate, let's go to 10-year treasury yield. 3.958%. 3.958%. 958%. And then market risk premium. Let's go to our... Oh, interesting. Jay Powell speaks after rates do not get cut, essentially. Okay, implied equity risk premium on January 1st, 2024. So 4.57%. $4.57. Why don't I use peers debt over equity for WACC calculation? In order to unlever and relever beta and like calculate all that, that is what you should be doing, but it takes too long. So we're gonna just do it like this. Okay. Now we're gonna need AMD's debt and cash. So let's go to its balance sheet, which is here. Okay, December 2023, cash 3.9 billion plus short-term investments. So 3,933 plus 1,840. Oh, actually, sorry, we just need debt right now. Accounts payable, current portion is 751 plus long-term debt, which is 1717. Okay, 751 plus 1717. Now, cost of that, this is a little tricky. I have to find the interest rate. Okay, each loan will be a better interest rate per annum to applicable plus a margin between secure overnight financing rate. Okay, this is for the revolver though. I'm interested in the long-term debt. Okay, 2.95%. $5 billion. So that's roughly this. So yeah, I'm gonna write 2.95%. Tax rate we have here is around 13%. I'm gonna just use 2023's. All right, so WACC of 11%. Yeah, that maybe a little bit high, but I think not like crazy, I guess. So WACC. Okay, it's 250. All right, I have a hard stop at 315, so we'll try to get as much done by then. I'll try to finish by then. Okay. So base case, let's call it this 11.24% that we calculated. Gonna conservative case, add 0.5%. Can I mine it 10.7%? I guess I think I would use this optimistic WACC, but anyway. 2.5%, 2%, 3%, pretty standard for terminal growth rate. I think next time actually what probably makes more sense is calculating terminal value with our exit multiple method, but this time we won't do that. I'll try to do that for the next DCF. Okay, so present value of unlevered free cash flow is our, let me also name our WACC and terminal growth rate number or cells. So let's name this WACC. Name this terminal growth rate or TGR. Okay, so present value equals that divided by 1 plus our WACC. Oops, I forgot to do one thing. Or we need to calculate our discount period. So in order to do that, okay. So I'm going to take a bit of a shortcut. Actually, no, I won't. So to calculate, first of all, so we're going to do something called mid-year convention. And to explain mid-year convention as I, kind of get all these numbers together and everything set up. When you get your cash flow, if you don't use mid-year convention, then essentially you're assuming that you get all of your cash flow at the end of the year, but that's not what really happens, right? You get your cash flow every day. Like whenever if you had like a lemonade stand and you were receiving, people were paying for the lemonade every day, then you're getting cash every day, right? So a simplifying assumption that bankers use is that, okay, you can't make things super complicated and, you know, assume that you're going to get all your cash flow like every day, because that would just be like insane to model. But you can make like a simplifying assumption that we get it in the middle of the year, right? Because that just like divides the year in two. So mid-year convention just assumes essentially that you'll get all your cash in the middle of the year. So I'll show you what this all means. So if we right now what I calculated here, year frac, this calculates the percentage of the year we have left, because DCFs, you're always looking at future cash flow. You're never looking at cash flow that's already happened. So for the month of January, that's already passed, right? For the rest of 2024, we have 91.7% of the year left. So what we want to do here for our, when we're calculating what discount period to use, we're simply taking this and dividing by 2. Because then what this assumes is in the middle of 2024 is when we're getting our cash flow. And then for our discount period here, wait, let me think about this. Yeah, and then for our, wait a minute. Yeah, and then, yeah, that makes sense. And then what we want to assume is that we are getting our cash flow in the middle of the following years. So essentially here, we're just, this is assuming basically middle of 2024, we're getting our cash flow. And then we want to just add another year here. So this is basically in the middle of 2025-ish. And then copy paste that for the future years. So essentially what this does is, instead of, so we're doing 1 plus our WACC to the power of the year, and instead of 1, 2, 3, 4, 5 for each of the years, we're going to get it in the middle of the year. And that gives us a slightly higher, more accurate cash flow. Okay, this something is wrong here. One plus our WACC to the power of the year that we're in. Okay. What am I doing wrong here? Present value of unlevered free cash flow. Oh, I think I'm forgetting something here. Okay, the WACCs are defined. Okay, so we get our cash flow divided, cash flow divided by 1 plus our WACC power. Definitely doing something wrong. Let's think. Okay, I'm gonna have to go to my old model. Sorry, I guess I'm a bit rusty. Oops, this is not that. What did I do wrong here? Oh, same thing. Okay, unlevered free cash flow. Divided by 1 plus your WACC to the power of the year that you're in, which is the same thing we did the other model. These numbers are... The only thing I can think of is that for whatever reason, this WACC figure is not... Oh, I think I named... Okay, I know what I did. I named these WACC and terminal growth rate when these should be... we should have... Okay, I know what I did. First of all, these should be switches. So equals choose that. Okay, sorry that was so slow. The computer is lagging. Okay, anyway, this should have fixed everything. So if I change this, okay. Cool, this makes way more sense. Okay, so now we have our cash flows. Then we can calculate our terminal value, which is our last year's free cash flow times 1 plus terminal growth rate. All of this divided by our WACC minus our terminal growth rate. And then we need to get our present value of this, which is the same thing, 1 plus our WACC to the power that of the last year. Okay, so then we finally get to our enterprise value, which is the sum of our free cash flows and our terminal value. And our cash we get from the balance sheet. It was 3933 plus 1840. 3933 plus 1840. That we have calculated here. So equity value is our enterprise value plus cash minus debt, 214 billion. Diluted shares, implied price per share. Diluted share count, where are you? 1649. So then price per share becomes $129.99, which I know is less than what AMD is trading at. But let's take a look at the assumptions that we decide to use. So let's just add some numbers here. So implied price per share and then current stock, current share price. So implied, upside, or if it's negative, downside. Let's also get rid of these. Okay. I'm going to clean this up a bit. Okay, so it's right now it's 3:04 p.m. on the East Coast. I know I said I would go through sensitivity tables today, but I have to get going in the next 10 minutes or so, so I unfortunately won't be able to today. I will definitely make an effort to do that in the next stream though. Okay, these are not switches. These are, what do we call these? Valuation. Let's call it valuation. Okay. So implied price per share here. It's always helpful to have the final output here at the top, because then whenever you change any of the assumptions, you can just easily refer to the figures. So current share price for AMD is 170. So I did this the wrong way. Huh? Oh, oops. So right now, based on the model, we have implied share price of 130, and then the current share price is 170s, which just clearly indicates that, at least based on what we have here, it's overvalued. The stock is overvalued. But then we have to ask ourselves, like, what assumptions we'd actually use. Personally, I think I would use a lower WACC, this 10.7%. Terminal growth rate, 2.5%. We can leave that. Assumptions, I guess first let's take a look at just a street case. That implies 115.28, which implies a negative 32% downside. If we were super optimistic on the stock, it would trade at 145.34, which it still implies a negative 15%. Personally, I think going from 2 to 3 here, so 2, like 122.41. So my range, personally, I'll just call this like range, would be this 122.41 to, if I was super optimistic, then maybe revenue and EBIT, I'd grow up. And I think if we, as I think about the figures we used, I think this optimistic scenario is possible, like considering the growth rates in the past, right? But you also have to consider this huge decline as well, right? Things can be very bumpy. It could go really high, could be bumpy. And you can also consider that NVIDIA, or many of the other competitors have experienced really, really high growth, right, as well. So I think this optimistic case is very achievable. So that's why I think like it's within range. Now this conservative case, obviously if things go awry, then also possible. But given how strong of a company AMD is, and I think that's why I'm using like 2 to 3, the base and optimistic case. And then for the EBIT as well, I think growing from 26% to 32% over time also makes sense. 27 to 34, like it seems like it's in the realm of possibility as well, based on the comps that we discussed earlier today. So my range then becomes 122.41 to 138.18. You could also argue that perhaps like our WACC is a little bit too high given how large the company is. But even still, what I'm getting from my kind of takeaway from all of this is that the company is very highly, it's just way too overpriced in my opinion. So would I buy? I would personally not. Oops. But, you know, with that said, this is just one model, one thing to look at. There's a lot of other things you want to look at. The way I would personally think about this is, first of all, our DCF from a base case and optimistic case both kind of imply that there's a lot of potential downside. And then also when we looked at the comps earlier today, at the beginning, I also, you know, pointed this out, right? That AMD is trading at a pretty high price and more than the rest of its peers. It's going to have amazing execution in order to justify these multiples. And if you combine what the trading multiples showed and then what this DCF shows, to me, it seems like a pretty risky bet. So unless the company just really surprises and, you know, does kind of unless it really surprises on the upside, then I would imagine that there's more downside potential than upside at current prices. With that said, you know, like let's say the stock corrects a lot and it goes to like 100 or so, then I think at that point, you know, it would be potentially like a good stock to buy, given that our intrinsic model, our DCF, shows that it could be in a range of like 122 to 138 or so. Also, as interest rates fall down and WACC increases over time due to like lower risk-free rates, your WACC will come down, and that could also make a meaningful impact to your valuation as well. So for example, if I made this like 9%, then we're at 176.57, right? So our WACC has like a huge potential impact to our valuation as well. So with that said, yeah, sorry again, I wasn't able to go through the sensitivity analysis, but I have to get going. And this model will be available to download for free about a day or two after this stream is published. And as always, thank you all so much for joining the stream. Every time I have it, I always think that the numbers will decline or like we'll get like no participants, but you guys are joining each time. It's not like there's thousands of you guys, but even though there's like 70 or so of you guys, that's good enough for me. And yeah, so I hope this was helpful, and I'll catch you guys in the next stream or video. Thanks guys, and peace.